Welcome, my friends. The news today is that big banks are quietly cutting thousands of employees, and more layoffs are coming. Even as the economy has surprised forecasters with its resilience, lenders have cut headcount or announced plans to do so, with the key exception being JP Chase. The next 5 largest U.S. banks cut a combined 20,000 positions so far this year, according to company filings. A key factor driving the cuts is that job hopping in finance slowed drastically from earlier years, leaving banks with more people than they expected. But before we get into all of that, please press the like button and leave us a comment below. We would love to hear from you. Please subscribe and hit the bell icon so that you are notified of upcoming videos when they are released. And before we continue, a word from the sponsor of this video. Today's sponsor is ProWorldNet.com. ProWorldNet.com is a job website specifically dedicated to licensed professions. Doctors, including any type of specialty. Nurses, and that includes all grades of nurses. Lawyers, regardless of area of legal focus. Teachers and professors, from kindergarten through graduate school, as well as any kind of job that requires a government license or certification. And ProWorldNet.com also includes short-term gig-type jobs as well. So be sure to check out ProWorldNet.com if you are looking for a job or an employee. The largest American banks have been quietly laying off workers all year, and some of the deepest cuts are yet to come. Even as the economy has surprised forecasters with its resilience, lenders have cut headcount or announced plans to do so, with the key exception being JP Chase, the biggest and most profitable U.S. bank. Pressured by the impact of higher interest rates on the mortgage business, Wall Street deal-making and funding costs, the next 5 largest U.S. banks have cut a combined 20,000 positions so far this year, according to company filings. The moves come after a 2-year hiring boom during the COVID pandemic, fueled by a surge in Wall Street activity. That subsided after the Federal Reserve began raising interest rates last year to cool an overheated economy, and banks found themselves suddenly overstaffed for an environment in which fewer consumers sought out mortgages and fewer corporations issued debt or bought competitors. Banks are cutting costs where they can because things are really uncertain next year. Chris Marinac, research director at Janney Montgomery Scott, said in a phone interview. Faced with rising defaults on corporate and consumer loans, lenders are poised to make deeper cuts next year, said Marinac. The deepest reductions have been at Wells Fargo and Goldman Sachs, institutions that are wrestling with revenue declines in key businesses. At Wells Fargo, job cuts came after the bank announced a strategic shift away from the mortgage business in January. And even though the bank cut 50,000 employees in the past 3 years as part of CEO Charlie Scharf's cost-cutting plan, the firm isn't done shrinking headcount, executives said Friday. There are very few parts of the company that will be spared from cuts, said CFO Mike Santomassimo. We still have additional opportunities to reduce headcount, he told analysts. Attrition has remained low, which will likely result in additional severance expense for actions in 2024. Meanwhile, after several rounds of cuts in the past year, Goldman executives said that they had right-sized the bank and don't expect another mass layoff like the one enacted in January. Last year, Goldman brought back annual performance reviews where people deemed low performers are cut. In the coming weeks, the bank will terminate around 1% or 2% of its employees, according to a person with knowledge of the plans. A key factor driving the cuts is that job hopping in finance slowed drastically from earlier years, leaving banks with more people than they expected. Attrition has been remarkably low, and that's something that we've just got to work through, Morgan Stanley CEO James Gorman said Wednesday. The bank has cut about 2% of its workforce this year, amid a protracted slowdown in investment banking activity. The aggregate figures obscure the hiring that banks are still doing. While headcount at Bank of America dipped 1.9% this year, the firm has hired 12,000 people so far, indicating that an even greater amount of people left their jobs. While Citigroup's staff figures have been stable at 240,000 this year, there are significant changes afoot. CFO Mark Mason told analysts last week, the bank has already identified 7,000 job cuts linked to $600 million in repositioning charges, disclosed so far this year. CEO Jane Fraser's latest plan to overhaul the bank's corporate structure, as well as sales of overseas retail operations, will further lower headcount in coming quarters, executives said. JP Chase grew headcount by 5.1% this year, as it expanded its branch network, invested aggressively in technology, and acquired the failed regional lender First Republic, which added about 5,000 positions. But what do you think? Please leave us a comment below and hit the like button. We would love to hear from you. Please subscribe and hit the bell icon so that you are notified of upcoming videos when they are released. Please share this video on social media. Thank you for watching.